It's great to be on board, and welcome to everyone who has come to join us this morning. So I am just going to start off with a thought for the day, and that is that happiness is getting paid, and this is a saying by Anon. So one of the key issues, I guess, with business owners face is getting paid. Everyone has struggled to some extent over the past couple of years with the impacts of what's been going on around in the current environment, and it's likely that your payment terms weren't enforced at some point, probably as strongly as they could have been. So this quote is really looking at that as that, happiness is getting paid, because ideally you've provided some value at some point to someone, and we want to be rewarded for that. So let's look at what this really looks like for you. So going to quickly just jump through an agenda for the day before we get stuck in. So going to run through the importance of getting paid, the seven causes of poor cash flow, look at your cash conversion cycle and how you can calculate that. Look at the best practice for a debtor system within your business, how you can get some quick runs on a board for you to get going forward, and then what the next steps are that you're going to take. And then finally, we will end hopefully with some questions. Before we start, though, just want to quickly throw in a quick disclaimer that we always have to put in, that the information obviously in this session is educational and is only general in nature, and I guess there's no substitute for tailored advice. And that's specific to your circumstances. So if you are having some issues or in your business and you want some help, please reach out to us or to whoever it is in your world that you speak to, and get some tailored advice to really help you along the way. Okay, so moving on to, I guess, the importance of getting paid. And then obviously, before we kick off, just want to make sure, again, reiterate what Megan said. If you do have any questions along the way, please make sure you do chuck them in the Q&A or the chat panel at the bottom, and Megan will pick those up along the way and throw those out. And then obviously we'll have time for questions at the end. Okay, so moving on to the importance of getting paid. So I guess we always like to talk about the three freedoms of business, and this is what business owners always want, and how we can help achieve all three of these things. The three freedoms being freedom of financial freedom, time freedom, and mind freedom. So mind freedom means less work and less work-related stress. This could mean finally getting a good night's sleep without tossing and turning and thinking about work at nights. Could also mean having more patience and headspace to enjoy time with your family. Time freedom is talking about having enough time to do the things we love and outside of work, essentially. So we want to make sure that we have where our business is there and it's serving us and not us serving the business, and it's creating freedom for us to enjoy getting up in the morning and going for a surf, or during the day when the swell's good, or is it coaching a kid's sports team, or having 3-day weekends. You might decide you only want to be someone who works Monday to Thursday, and you take a Friday off and have a 3-day weekend every day. And then the third freedom is financial. So we're talking about here is, I guess, your business generating and having the discretionary income that you need to enjoy the lifestyle of your choice. So this is around having the financial numbers, the financial ability to access the funds you need to live the lifestyle you want, whether that is buying a new car, taking family on holidays on a regular basis, and I guess also using your business to generate cash that is going to, I guess, provide a nest egg, or a source of wealth for you for retirement. Obviously, that's always something for some people it's maybe a long time off, but I guess it's something to always think about early. The earlier you can think about that, what that retirement number might look like, and start planning for it now, with the impacts of compounding interest over time and compounding returns, the much easier it is to reach that target in the future. So in reality, all three freedoms work together to provide you with a better and healthier lifestyle. And it's a matter of finding a balance across all three to live the lifestyle that you want. Often there's a trade-off between the three, depending on sometimes if you want more of one, sometimes you have to give up a little bit in the other space. But it's always finding that balance. So getting paid faster will help you to achieve more freedom, essentially, in your world. It will provide you with more cash flow. So that's the financial side. It will be less stressful because you're not worried about how you're going to find money and where you're going to find it and chasing people. So that deals with the mind. And I guess it's going to take up less of your time to chase people. So it's giving you the time freedom. So it helps for all three. So by having a strong debtors process in place, you'll be able to save time previously spent following up slow payers. You'll have less, you'll be less stressed and no longer wondering how you're going to pay your invoices and paying your suppliers that are overdue, or if you're going to be incurring any late fees. And you'll also have more cash in the bank, offering you better options to improve and grow your business and or your financial goals going forward. So I'm going to move on and look at the 7 causes of poor cash flow going now. So these are in general are the 7 causes across the board. So they apply. Don't always apply at the same time. Usually you only see in most businesses 1 or 2, but at some point in every business's journey, 1 or more of these will have popped up and caused an issue at some point. So number 1 being an inadequate accounts receivable process. 2 is an underutilized accounts payable process. 3, an insufficient inventory process. So not having a correct process for either making sure you're not ordering too much stock and tying up cash, and an inappropriate debt and capital structure. So being overburdened with too much debt in your business is obviously going to have a significant impact on cash flows. Overheads that are too high, so we've just got too much expense in our business, and so we need to look at options to reduce those costs to free up cash. Your gross profit margin is too low, so it means we're essentially probably not charging enough for our services. We're not generating enough margin on top, which is the gross profit margin is really what's there. It comes after your direct costs. That's what's there to cover your overheads and generate. It's basically your profit. Cover your overheads and then leave a profit at the bottom. So the higher you can get that gross profit margin, the better profitability is going to fall out the bottom of your business. And then the final cause here is sales are too low, so we're just not able to reach our customers enough and generate enough cash flow, enough sales in our business. So by looking at these causes of cash flow and addressing each of them, you'll be able to free up as much cash as possible within your business. We can help address each of these if you do need some help with these on the way. But today we're going to focus on the first one, which is your accounts receivable and debtors processes, because that's ultimately about getting paid, right? So that's the whole reason we're on this call today. So just in case I'm using too much, I guess, accountanese, which is too much strange terms in accounting language, debtors is just another word for your accounts receivable, or the invoices that people are going to pay you, because you've invoiced someone and they need to pay you. So let me know in the chat if I end up using too much accountanese or accounting language and start losing you, and I'll do my best to explain everything as simply as possible, and try and remove some of the accounting language as best as I can. So if you think one of the other causes may be relevant in your business, other than the, I guess, accounts receivable processes, do reach out and let us know at the end of the session, and we'd be more than happy to jump on a call and sort of let you know how we can help. Okay, so let's have a look at the impact of slow paying customers and how that impacts your cash flow going forward. So this is what we call your cash conversion cycle. So, and this is an example of how what one of these looks like and how you might be able to calculate it. So looking at this, everyone's will be different, and depending on your industry and what type of business you run, it will always be slightly different. But this is just a brief example for us to work through today. And then again, if you want to potentially look at ways to calculate this for your specific business, please do reach out, and we'd be more than happy to help. So obviously service, this is based on a business which is providing goods. So it's obviously got a lot of stock. Whereas if we were talking about a service-based industry, that would be slightly different because you don't have any stock. So you have the kind of the first half of this graph, this chart it disappears. So in this example, sorry, I've gone skipped a couple here. So in this example, the business buys the stock from its supplier, and it takes on average 35 days. So we're buying stock at day 1 or day 0 here, and it takes on average, we've got pretty flexible and good payment terms for our suppliers, and we get 35 days to pay those suppliers. So that's when cash goes out of our bank account, and then takes, which is what we call our average stock holding days. And then what it then takes us once another 45 days to essentially sell that stock to our customers. So what essentially we've got there is we've got we've got from 0, it takes us 65 days essentially to just from the day we order that stock to making that sale. That's 65 days that we don't have that cash in our bank. And then what we have then further from that is we're providing payment terms to our clients, which means they actually then take on average another 45 days to pay us, which essentially means from start to finish, from the day that we were to purchase our stock, all the goods that we're going to sell, to the day we receive our payment from our client, the cash comes in the bank. That takes it's over 110 days. But what we're really concerned about here is the difference between how long it takes essentially from the time that the cash goes out of our bank account to the time that we receive the money here. And in this case, that cash conversion cycle was the 65 days, which are being the average stock holding at the start, plus the 45 days, which is what it takes clients to pay us. And then we take off the 35 days at the start that we get the terms that we get to pay our suppliers. So a total cash conversion cycle was 75 days. So that's a long time, right? So that's a long time for us having to have money going out of our bank account in this, you're the business owner, and then you're essentially having to finance or cover that cash flow, cover your expenses and everything for 75 days until you recoup that money. So let's say this business had annual sales of, say, $500,000. So if they don't do anything to do nothing to resolve their debtors processes, and the average receivables days was, say, to blow out from 45 days to 55 days, that would mean there'd be an additional $13,700, or 13 to 14 grand of cash tied up in their debtors and unavailable to be used in their business, either to pay their own bills, to pay their staff, to help grow the business. That's quite a chunk of money, and it's only a sort of a 5 to 10 day difference in terms of people paying you out the other end. So, and often you sometimes don't have a lot of control over that, other than if you're putting in a really robust debtors process. So, however, if they were to put in a really strong, if you do put in that really strong process, and you were to have the opposite effect, which was reducing this 45 days down to 35, then again, that can free up that cash flow faster. So that can be saying we've got now a 14K of cash sitting in our bank account, which is helping us grow the business, reducing our stress, and paying everything on time at our end, and making our business cash conversion cycle faster and getting our bank account working along the way. So I hope that makes sense. Let me know if, again, at the end of this, if you want some help in looking at how we can calculate this for your specific scenario. So I'm going to move on to looking at your debtors system now, which is what the key focus for today. So what does a strong debtors system look like? Setting your expectations with customers from the start of the relationship, I guess, is the key focus. It is the easiest way to do this, and when you have a clear and documented process that's followed every time. So you want to make sure upfront everyone is crystal clear. All your customers know exactly what your debtors process looks like, what their payment terms and the like look like, and it's all documented out for the client to follow, and also for internally for your staff to follow. So we're going to look at best practice, which involves documenting your system for consistency and clarity across the board for customers and for staff, and also for setting a robust terms of trade using guides and scripts, which we can help provide some templates for the guides and scripts, and potentially utilizing third-party credit control services, which can be a really useful way of helping in this space. So what is best practice? So if you don't already have a written debtors process, then this should be your first action following this webinar. I'd really encourage you to go away and you look at writing a process for this, potentially use the guides that we have, we will provide after the session, and get that process documented and ready to go. So a systematized process details your expectations of how your customers and details your customer expectations and when and how your team should respond to ensure expectations are being met. So if someone's a slow payer, then everyone knows what the ideal outcome will be next. So this provides good clarity for your team and ensures customers are followed up in a timely manner and consistent manner, and which will drive better payment habits in the long run. So if you have that from day one in place and the regular chasing and that process is followed, then it creates habits from your customers. So they understand, okay, these guys they want payment, they expect payment within X period, and we need to stick with that. And then it teaches your customers to stick to your payment terms. So you need to document things like how quickly you invoice your customers. So whether you invoice within 3 days of providing a service, or you invoice at the end of a month. You need how long your customers have to pay you after receiving their invoice, and what happens if they don't pay you on time. The sooner you can bill your clients, I guess, the sooner you can get paid is one of the key things. So I always advocate for not waiting till the end of a month if you can, and then invoicing then. It's once you've provided the service or provided the goods to your clients, is invoicing as soon as possible after that, and using payment terms that reflect the date that you are within a certain date range of the date of invoice, to ensure you are getting paid faster and you have that money sitting in your account. So when customer has a transaction fresh in their mind, it is more likely that they will pay you quicker. So it's not something that happened 20, 30 days ago and they go, oh yeah, cool, I've got an invoice now. I'll wait till the due date and I'll pay that whenever that is. You want them to go, okay, cool. Yes, I've done that service. I've received that good, and here, okay, I'll go and pay for it, and get it sorted. So if your invoices allow payment by the 20th of the following month, then you need to change this. So consider requesting payment within 7 days of the invoice. 20th of the following month it's too long. If you've done a service within the first week of a month and then you have to wait all the way to the 20th of the following month, that's 40 to 50 days. And that's just, I think, is unacceptable in this day and age. People should be really paying within 7 to 14 days at the most of a date of an invoice. So that's something for all people to look at. Where there's this kind of default rule in business in New Zealand that the 20th of the following month is the standard, but it's not. It needs to change. And I think it's something that all business owners should be looking to change their payment terms and enforcing them as much as possible. So as a customer yourself, if you receive an invoice and it's not due for, say, 6 weeks, you're probably likely to put it to the side and pay it later, right? In fact, you'll probably forget about paying it until you get the reminder that it's overdue, because the payment term is just too long, and the time frame between the good or service being provided and happening versus when the payment is, you've forgotten about that. You've forgotten about what it was you purchased 6 weeks ago. Therefore, you kind of forget there's an invoice and the payment to go out the door. So you need to link the due dates for your invoices to being much closer to the service or the goods being provided. And if an invoice is due within, say, 7 days, you're more likely to pay straight away. So these payment terms should be clearly set out in your debtors processes. That's the fundamental piece. Oh. Sorry, system's going all over the show. So also, So also, do you make it as easy as possible for your customers to pay you? For an example, can your customers click on a link in their invoice to pay online, or what other options are there for them to pay? So do you offer options in terms of, is there options to pay via direct debit, via credit cards, obviously bank payments? There's a multitude of options that potentially are out there. It's looking at what ones you provide and what are the best ways, and how can they help you to make your customers life easier so they can pay you faster. So best practice would be ideally be to have would always be different for each business. So it really depends on the industry you're in and what your specific scenario is. But the key is to consider all the options. There's a multitude of them out there, and what is relevant to your business, and make it as easy as, it's all about making things as easy as possible for your customers to pay you in this day and age. We're all very much an instant gratification kind of world, and we're all also very much attached to devices. We have a computer in our pockets with our phones these days. If we can literally click on a button, and you could often, an invoice will come through, you'll pick it up on a phone. If you could click on the spot, click a button and have that payment be made there and then, a lot of people would be likely to pay on straight away at that point in time. The other thing you also need to be clear about is your following up process. So do you wait until debtors are, say, a week overdue before you follow up, or do you just follow up overdue debtors once a month? Ideally, best practice should be to send a reminder to your customers the day after an invoice becomes overdue, to request immediate payment. Right? You've provided your service or the goods, and you've given a period of time to pay. And so once that due date has hit, if that payment hasn't been made, you should be following up straight away to ensure that clients are mindful of the fact that they have an obligation to pay, and enforcing that payment as much as possible. So your process should also set out how your debtors are followed up, and the follow-up methods that you use. So this could be anything from automated reminders, which can come out from Xero or MYOB. They can be set up. It could be a personalized email, so becoming direct from an email. It could be a text as a friendly reminder, or even picking up the phone and just touching base with the client to see what's going on. So you should also record in your debtors process all contact with debtors. So you need to have a system where you can make sure you are recording all the correspondence that you're having, or make notes somewhere so you can see a chain of I guess correspondence. So whether it's an email, phone call, whatever it is, dates, times, and what was discussed. And so that way, and also writing down, I guess, if the customer has agreed, if they come back to you and give you a yes, I'm going to pay, and I'm going to pay it on X amount on X day, then you can document it into a system somewhere. So that way you can say, if they're going to say, I'm going to pay that in 3 days, then you can go, okay, cool, I'm going to wait three days, and I should expect that money to come in. And if it doesn't, then you have a fallback position to go, okay, I need to follow up that client on the 4th day to go, okay, you said you're going to pay it, you haven't, and it's the time that gives you the trigger to go make another phone call to chase it up. So there's lots of options for that. So whether you use, say, a cloud-based customer relationship management system, or a spreadsheet, it doesn't matter what you use. Spreadsheet is fine, or a system online, depending on what you are used to. As long as you have a standardized method of recording this information, everyone across your business is aware of that. So whether it's you doing the phone calls or having these conversations, or whether it's someone within your team, they're all following the same process. And finally, if you've exhausted all the avenues and the customer still hasn't paid, it's time to potentially look at referring them to an external debt collection agency. They'll be able to chase up the customer for you and save you the time and energy, right? For usually a very small cost. There's a point at time where it becomes counterproductive to keep having your team chasing things and costing essentially your internal team money. And it's a commercial decision usually around what is the cost of that person's time within your team to do all this chasing versus how that time could be better utilized within your business to achieve other outcomes. And so then it's looking at, well, can I make can I simply outsource this to someone else who then, for a small fee, being an external debt collection agency, who are likely to probably have a better success if it's not, often it's the way, they have a better success in collecting because it's not coming from your firm directly, and they're likely to be a bit more, they're more pushy and get the better result because that's what they're driven to do. Okay, so we're going to look at the next step is terms of trade as again another one. The next step is for best practice in your debtor system. So terms of trade are obviously essential in providing when you're providing goods or services to your customers on credit. So these need to be accepted by your customer before you provide them with the product or service, and you should both retain a signed copy of the terms of trade agreement. So it's vital if you're going to provide some sort of a credit policy that you have a written agreement to fall back on. So if the terms of that agreement are ever broken, then you have a documented process and system where you can follow that up with clients and work out what they're doing. So the terms you should include will depend on, I guess, the nature of your business. So for some people, this will be a relatively short list of terms, right? If it's just providing a service and we'll pay within X days. For others, these things can be huge. They can be multi-page documents, setting out all sorts of details in terms of disputes, and it really depends on your industry. But there are some key terms that I guess all businesses should include in their terms of trade. So firstly, you must define and include the payment terms. That's a given. So both parties are clear on exactly when payments are expected. How long after invoicing does your customer have to pay? How they are expected to pay? So are they expected to pay by bank deposit? Are they expected to, if you're continuing on your industry, everything's done by direct debits, and a direct debit mandate needs to be set up, and detailing those things out. Does your customer need to pay a portion up front and then the rest on completion? So that might be in the case of I guess it's a progress payment, or it's an upfront payment in the trades industry, or something to cover the cost of materials. So it might be a 50% upfront to cover materials and then 50% on completion. Whatever your payment terms are, they need to be set out perfectly clearly so all parties involved are clear on what's going to happen. You also need to detail, I guess, what your debt collection process will look like if the payment terms are the terms of trade are broken. So upon laying out these expectations for payment, I guess you want to make sure the customer knows that if they are going to break these terms, then you will look at taking debt collection agency action against the firm or the individual payer. And lastly, you must clarify in your terms of trade, I guess, who covers the various costs incurred in the instance of late payments. So, for example, do you have a clause stating that the customer will be liable for the cost of any debt collection? Then if you don't have that, and if you don't have a clause in there saying the customer will be liable for any cost of debt collection, then you end up wearing the cost of that. And that ends up being a bill for you. So it's an additional cost for you. So obviously you're getting paid. So can only charge interest on late payments if there is clearly stated in your terms of trade. So if you don't have that set out in your terms of trade, it's very hard for you to be actually legally be able to charge interest. So you may charge an administration fee to cover extra resources used to follow up any overdue payments. But again, only if this is clearly stated in your terms of trade. So we've got a couple of templates, and we will provide around how to set out your terms of trade. And there are some examples of this. And if you need any help, then please do reach out. Excuse me. I'm off mute. That's cool. Okay. So the next step, I guess, if you are looking, when you are chasing people, is the key thing to make sure we're looking at doing here is we're applying empathy to customers, right? So before we unleash, I guess, your inner Rottweiler, it's important to apply empathy, right? So the last few years have been tough on everyone, and I guess we never know what could be happening in someone else's personal life and issues and things that may be happening. And if we apply empathy to clients, we're more likely to get a resolution to our payment if we are empathetic to this situation and be understanding, essentially. So one thing to consider is how loyal your customers have been in the past. So are there regular customers who's paid on time in the past? And if that's the case, then we potentially likely to be more lenient, and you can give them a bit of room to move, because maybe there's just something going on in their world that they've forgotten, or there's whatever it is, someone's ill, whatever it is. In order to, I guess, what you want to do is be a little bit lenient to, I guess, preserve a relationship, right? You don't want to go all guns blazing and annoy a customer and potentially lose them as a customer if they've been a really long-term valuable customer to your business. Ask them how they're going. You know, if the customer is on another business, if the customer is another business owner, you can probably relate to the stresses that the business owner is facing. Maybe they're waiting for a big customer at their end to pay them. Who knows? They've obviously probably potentially, if they're not paying you, they're potentially feeling a cash flow pinch at their end. But I guess asking them how that's going, it opens up a dialogue and a conversation, and you'll find that you'll get much better outcomes. And understand that it will obviously probably, rather than them just going, oh, I can't pay, you can work through scenarios around, okay, well, when can we pay? You know, if that customer is likely to pay you in 3 days, 5 days from now, can we expect our payment after that comes through? Asking how they're going will definitely give you insights into the potential causes of their late payments. So it's really important to identify those and make sure the next steps, to work out what next steps you can take and also they can take. So helping them see what the future may look like as well is really important. And then this leads into the next point of giving some payment flexibility. So the goal is to get paid, right? So the sooner the better, but ultimately you want to be paid in full. And avoid having to write off a debt and forgo that amount and forgo that payment. So consider offering options. You know, perhaps it's giving someone time to pay. You know, giving them I don't know, they can pay it in installments over a period of time rather than having to pay the full amount immediately. Ultimately, what the clear goal is to collect that cash, but it doesn't always. You know, if they are struggling, is being able to, I guess, provide some leniency and some time to pay, so that way we at least collect everything. It may just be slightly later than we'd hoped. So you still need to ask, and you still need to be firm that you expect payment of the full amount to be made by the agreed date. So ask the customers to get in touch immediately if they are unable to meet the agreed payment terms, so you can essentially discuss alternative options for them before. Ideally, that's in that scenario, you want people reaching out to you going, hey, look, I'm not going to be able to make this payment by due date being next week, but I know I'm going to have the money 3 days later. So it's all about communication. So that's both ways. So with your customers to you, but also you to your suppliers. If you don't think you're going to be able to make a payment on time, it's just open a dialogue and have a conversation to make sure everyone's aware and on the same page of what's going on. The other piece is really about having backbone and heart. So this is a mindset that we really believe in. So having backbone and heart is the key to balancing your expectations around getting paid and the relationship with your clients, right? So you need to have backbone and stand up to excuses, essentially, from your clients. So there may be legitimate reasons for the late payment. However, in most cases, you're running a business and you have to pay your own bills. So you need your customers to pay you still. So regardless of what's going on in their world, you've still got your bills and expectations and wages to pay. You still need your customers to pay you. So it is okay. It is 100% okay to ask for payment and be firm with your customer, and you must be firm with that customer to ensure you get paid. But you also have to balance that, right? So this is where the tricky piece is. So you need to balance it with the heart side. So you need to link it. Ideally, what you can want to do is try and link into your purpose statement of your business, considering all the options for payment and being flexible and considerate in your approach. And so in saying all that, I guess talking to customers about overdue payments obviously can be an awkward thing to do, and for some people it can be quite uncomfortable because the relationships are it's usually relationship based. That's why I guess we've got a couple of resources here. I've got some quick examples of them on the screen here, but so we've put together these scripts which we can provide you with to help you guide these conversations with your customers. And so whether that's with yourself doing this or that's your team, so these scripts help you discuss payment with customers using empathy, but also being firm in requests for action is to be taken seriously. So you want to make sure that you have a standardized process, but you're still balancing everything with the backbone and heart along the way. So we also have a credit management guide, which helps you to manage your accounts receivable and focus on your key processes that can reduce your business's exposure to risk over time. So we're happy to share these scripts and guides with you at no cost off the back of this webinar. Just let us know if in the feedback at the end, or send us an email if you'd like a copy of these. It's just a little quote. So today is your opportunity to build the tomorrow you want. So I guess by bringing in all your cash and collecting it as fast as you can, that's helping you essentially take that cash and build the tomorrow you want using that cash flow. So using credit control services, so another option to consider, particularly for those of you who find these conversations uncomfortable with clients about getting paid, is to outsource your credit management. So referring it back to a third party, referring back to the 3 freedoms I spoke about at the beginning. Outsourcing helps you achieve the mind freedom and potentially a bit of the time freedom too. It frees up your time to work on more important things in your business and reduces the stress you face chasing up overdue payments. So outsourcing appropriate things is the best practice for most businesses. And this applies to credit control services, but there's a whole multitude of areas in every business which outsourcing could potentially apply to as well. So it's essential that you build a relationship with your chosen provider if you decide to go down that road, so they can understand your core values in your business. They understand your style of communication and the language you use. And it sounds like when those people are collecting on your behalf, because essentially, although you're outsourcing, they are still representing your business. You don't want, I guess, to use a provider who goes straight in there all guns blazing, and it ruins your chance of any future relationship with the client. Yet it needs to be managed carefully. But we still have to be very clear on the expectations and check in to ensure that these are being met with your provider, and also how those potentially even looking at, which is a strange way to go about it, but it's almost surveying your customers as well to see how they found the process went if you are using those third-party providers. So outsourcing can be a great option. However, it shouldn't be the ambulance at the bottom of the cliff option. So you can't expect them to fix your customers' existing bad payment habits on their own. So the reality is, if your customers are bad payers, it's likely because you've actually trained them to be bad payers potentially by not having clearly defined terms of trade and debtors processes in place in your business. And by not having those things clear, then you've essentially trained and allowed your customers to become bad payers at the other end. So if you're expecting these third-party providers to essentially fix things for you, you'll probably fix the bad habits, then it's probably not going to be the right outcome for you. So if you want the ambulance at the bottom of the hill, it's likely you're going to have potentially some brand damage and lose some relationships with customers going forward. So that's why we've developed resources to help you. So no matter what option you choose, I guess, whether you use credit guides and call scripts that we've developed, or you develop your own, or use an outsourcing provider, the important thing is to have the systems in place in your business to ensure that you get paid as quickly as possible while retaining your relationships with your customers. That's the ultimate goal, right? You want those customers that are already to stick with you and to come back time and time again and love working with you and love working with your business. Okay, so looking at options around how to getting some quick runs on the board in your business. So hopefully you found the information in today's webinar valuable. The key is to ensure that you go away from this and take action. So you don't need to try to do it all at once. It's taking it, I guess, in small steps. So version 1 is always better than version none, is what I always like to say. So by taking small steps along the way, you'll ultimately end up at the end goal of where you want to be. So simply focus on just those small steps and to improve your systems and your processes, and you will start getting paid faster. So the first thing you should look to do if you wanted to get those quick runs of the board is to calculate your own cash conversion cycle. So you know actually how long within your business your cash is tied up in either your inventory or your debtors or your work in progress, and you can understand the impact that potentially a late payment or a late payers will have on your cash flow. So that's one thing I would certainly suggest you do. So that will give you a much better understanding of the cash flow of your business and your specific scenario. Again, if you need any help with that, please do reach out to us. Then have a look at your current debtors process, if you even have one. There's a lot of businesses that don't have a process at all for this. So if you don't have one, then make this a priority to get it in place. So review your entire process as it's written and compare it to what actually happens as well. So it's one thing to have a process, but it's another to see whether that's followed up and it actually reality mirrors that process. It's likely that over time the process is potentially being evolved, but potentially maybe the documentation hasn't been updated along the way. So you may be doing one thing now which is very different to what the documents and the process, the documented process says, because it just simply needs to be updated to reflect changes over time. Or perhaps steps in are regularly being skipped. So make sure it's up to date and share it with your relevant team members. Share it with those relevant team members to ensure, I guess, your processes and the are understood, and perhaps even provide everyone with a checklist to step through with each customer. So they're great. There are great free tools out there. Like you could use something like Trello that can help with process management and documenting out a process online and building out something that would be really robust for your business. The next step, I'd say, to getting some quick runs is to review your terms of trade. If you provide terms of trade to your customers, and make sure all the relevant clauses have been included and written clearly, so that everyone, your customers and your internal team, are all on the same page. So ensure you have a process to obtain signed copies of these before providing any products or services on credit to your customers. Can't provide anything on credit without a terms of trade, because it just you're not covered at the other end if you don't have those things in place. We do have some templates that we can provide if you need help with this, so please do reach out. And the last piece I'd say is so two more things is that using scripts. So start using scripts for those conversations, those difficult conversations with clients about late payments. So you can use the templates that we've got, if you like, as a starting point, and update them to reflect your business and the tone and the language that you use in your conversations. Or you can develop your own, I guess. But having the scripts helps to build confidence and ensures consistency across team members. Ultimately, confidence for the people, because they understand where the conversation should go and how to structure the conversation. And also it's bringing cash flow into your business, and cash flow in any business is confidence. So across the board, it makes sense to have those scripts in place. And lastly, but by no means least, looking at outsourcing your credit management to third parties to free up your time and reduce your stress levels. So whatever you do, don't keep working for customers who are late payers, who are bad payers over time. If they're consistently always late payers, they're potentially people that we may should look at whether we should keep working with those people, and should we I guess not have them as a customer anymore. You're running a business, and right now you need to reduce your risk wherever you can, and late payers certainly provide a fair bit of risk in any business. So action time. I guess, what are you going to do now? So it's essential that you decide what you're going to commit to. to commit to doing next. So the sooner you can take actions, I guess the sooner you can free up cash in your business by getting paid faster. So look, make a plan for how you'll implement what we've discussed today, and how you're going to put that. And then once you've got to the plan, is then create actions or milestones and assign them to people. So make them visible and assign to people, whether it's people in your team or to yourself, so that you can get, I guess, traction along the way and to tick those things off and get moving forward. Part of that planning is also to surround yourself with experts, I guess. And look, we're certainly here to help in this space if you need some guidance and assistance. So I guess the last thing I'll say is to really focus on what you can do, not what you didn't do in the past. So the past is the past. We can't change that. But I guess what we want to focus on is what you can do now to help going with your cash flow now and into the future. Cool. Okay, so we do have, I guess, some options around how we can help. So this is just a quick view of what the options we have. So we can offer you with, if you are looking for some assistance in this, we can offer you with what is a cash flow and a profit improvement meeting, where we can sit down and look at your business, and we can actually build out a model saying, look, by making tweaks here, there, and there, reducing your debtor days by 5 days or 10 days, whatever that looks like, increasing your customers, your retention rates with customers, whatever that number looks like, can have X amount of impact on your profits and cash flow over time. So there's a fee for that of $500. However, if we only we make that session as free. If it's free, if we can't find you or save you any cash or profit in your business. So but at the end of that session, if we haven't been able to identify any improvement in your cash flow or profits going forward, then there'd be no charge. So it's a pretty risk-free option to look at in your business. We would guarantee it. We would always be able to minimum provide at least 3 times the value of that session. So we'd at least be able to find as a minimum $1,500 of free cash flow and or profit in your business. So it's a really useful session to have. We can also then look at providing cash flow forecasts for your business at a cost. Obviously, these are costs around $2,500. This is, I guess, gives you confidence, I guess, what your business looks like going forward and where its cash position is likely to be. And if you are having potentially it allows you to find where there might be some holes or some issues in the future when you're going to have some tight periods for cash flow. We also offer a cash flow management coaching program. This is actually a program that's run over a 12-month period. So it's bi-monthly meetings. Sitting down with one of our senior team here, running through all the 7 key causes of cash flow in depth as they relate to your business. And then along the way, we will teach you what those are, what actions you can take away and put in place in your business to help, I guess, fix those issues if they exist in your business. And then finally, we always offer complimentary free meetings. So if you want to come in and have a review of your business and look at what there might be out there, then please do reach out to us. Again, as I said at the start, I guess all the little disclaimer again, all the information in this session is educational and general in natures, and there's no substitute for specific advice. So if you are having some issues around cash flow in your business, please do reach out to your advisors or reach out to our team, and we can certainly help you build a tailored set of advice that's going to help you fix the issues in your business. There are several ways that we can help, so please do reach out. Cool. And I think that is us. So I'm going to hand back to Megan. Hopefully we've got some questions. Be keen to see what everyone's been thinking of today.
Hi guys. Yes, there have been a couple of questions come through. So Gareth, the first one is, how often should you invoice out a month?
Great question. It depends on your business, but ideally you want to invoice as close as you can to the good or the service being delivered to the customer. So at the end of that period, so if you're providing a good, that's usually a relatively easy one. Someone comes in and purchases something over the counter in your business, you want to be providing that invoice straight away. So within sort of 24 hours, if it's not over the counter provided at this on the spot, then certainly emailed electronically within a sort of a 24-hour window, so they are aware that they need to pay for that. For service providers, that's a slightly more tricky one. I would say you want to always, again, you wanted to link the invoicing with the delivery of that service. So depending on the length of that service, but if that service is, say, a 2-week period, or 3 weeks period within a month, then if that's finishing kind of mid-month, you want to invoice within, I would say, within a minute maximum of 7 days of that service being finished and delivered. If the service is a longer period, so it's something that goes over many months, then you should be looking to invoice progress bills along the way. So, that'd be, I guess, ideally be monthly or fortnightly, going through and looking at, okay, this is the time that's been spent to date, or the service that's being delivered, and then delivering those, sending those invoices out to ensure that, again, you're trying to connect your income, and when you're collecting your cash from your customers, to when your cash needs to go out the door to paying your suppliers and all your staff. So yeah, it's all about connecting. The shorter you can have that time period between the good or service being provided with the invoice going out the door, then it's always going to make your cash collection better. Hope that makes sense.
Okay, I've got another question here. Just before I read it out, just a reminder, if you do have any questions, please just fire them through now. And of course, feel free to give us a call if you want anything answered personally. The other question was, what payment terms should we be using if not the 20th of the following month?
Yeah, good question. The 20th of the following month is kind of, I hate that term. I really do, as a payment term. I think with no more than 14 days is really what we should be, what all businesses should be striving for. 20th of the following month, I think I said earlier, if you're providing a good or service in that first week of a month, so between the 1st and the 7th, you've essentially got to, without the cash, you've essentially probably paid your suppliers and your staff for what that work they've done. But if you don't get paid to the 20th of the following month, that's 40, 50 days in some cases before you get paid. And I just think that's just ridiculous. I think most businesses should be really aiming for between 7 and 14 days as their standard payment terms.
Okay, we've just had one more question come through. What options are there for making it easier for customers to pay, and can you recommend any?
Okay, I think we're talking about how we can make it easier for customers to pay. So yeah, there's a huge number of options out there. Bank transfer is obviously the standard one. What you really want to look at, I guess, is things around credit card payments, right? So with the likes of Xero and all those things, these services, you can actually nowadays have a pay now button entered on your invoice. So if someone gets an invoice from them, they can open it up, click a button, and it will take you through to pay. So that's using things like Stripe or PayPal, which have really great integrations with Xero, and they can be set up within the system to take credit card payments on behalf of clients. There are other options, I guess, in terms of direct debit. Direct debit is a great way to, depending on your business, if you have regular constant contact and supply to your customers, then having direct debits in place is another really great way to go about things. Go cardless is a really good recommendation for if you're looking at setting up direct debits. Great system, has a really great integration with Xero and works pretty seamlessly. It's certainly one that I would recommend. In terms of the credit card piece, yeah, Stripe is probably the most used one in this part of the world. They're probably the key things, the key options that are out there these days.
Cool. That was all the questions that we had sent through. Thank you for those great questions. Thank you for all attending this webinar, and hope you have a great day. Thank you.